Energy Transfer looks to be severely undervalued and offers a yield of 9.53% currently. But at what price should we be looking to enter this stock? Today, we're going to look at the historical information and performance of ET. We're going to take a look at their income statements, their revenues year on year, that bottom line net income, their balance sheet, their total debt versus their total cash. We're going to take a look at their dividend safety and some very important financial metrics. And as always, we're going to take a look at our stock valuation model. What is the intrinsic value of Energy Transfer? And what should our acceptable buy price be given our margin of safety? Now, the stock is up 11% year to date. It is trailing more towards the upper end of the 52-week high, and it has a very nice starting yield of 9.5%. Now, for those shareholders who have been holding the company for the last 10 years, you would be down 17%. So today's episode, we want to find out what is the perfect entry and make use of that very high dividend yield. Now, looking at their revenues over the last 5 years, typically we like to see 3 to 7% increase year on year. December 2018, 54 billion worth of revenue was reported, and December 2022, 5 years later, just shy of 90 billion. So very nice increase over the last 5 years. However, we can see over the period there were some years of a decline, and then we can see from 2020 to 2021 there was that sharp increase. So over the period, it is nice to see. As you would expect, there are going to be increases and decreases over the course of a business, but the perfect scenario, like Energy Transfer, is over the last 5 years at a minimum we see a nice increase. Now we want to see how that compares to their bottom line, that net income. So December 2018, 1.75 billion worth of net income was reported, and 5 years later, 4.7 billion. So almost a 3 times increase. Very nice to see. But also what we can see here is that there was a year where there was a net loss, but the following year they did pick it up to a very large increase. So over the last 5 years, it has grown quite significantly, but there have been some years in between where we can see a drop. Now we want to take a look at that balance sheet and have a quick look at their total cash versus their total debt position, and just ensure they are able to pay off the debt whilst paying a dividend. So we can see their cash has gone from 420 million in December 2018 to around 330 million in their latest quarterly report. So there was that slight decrease over the last 5 years. Now, without seeing their total debt, we can't essentially create a clear picture, but we can see here total debt 46 billion sitting on that balance sheet, with their last report, their latest quarterly report, 48 billion. So the total debt over the period has remained relatively flat. There is that increase of 2 billion, but over the total debt it is a very small amount. So what this information does tell us is that they have a lot of debt sitting on that balance sheet, but let's see how the financial metrics looks and how it affects that dividend safety. So dividend safety score of 50, making it borderline safe, with a market cap just over 40 billion, making it a large cap company. Now, a few key metrics that you can see on screen very quickly. They have been paying dividends consecutively for only 1 year. We'll look at that further shortly. They did increase their dividend during the last recession, which is positive to see if you believe we are entering a recession. However, what wasn't good to see, a negative 42% sales during this period, which was below the average growth rate during the recession, but it is understandable for the nature of the business. But even though they did have below average growth, they still beat the S&P's negative 55% return, although they still had a negative 44% return. Now, dividend growth, we like to see above 4% due to inflation. What we can see here, a very, very small increase a few months ago in April. Last 5 years, in fact, negative. And the last 10 years, positive 5%, just beating inflation. So a lot to digest here. What I would say is we need to take a look closer at the other financial metrics and understand whether or not it is a good starting point and whether or not that very high yield will be sustainable. So dividend yield theory states that a company is undervalued when the current yield is sitting above the 5-year average. So this would show that it could be undervalued. Again, the forward ratio, again, it is above the last 5 years, but fairly in line, so it could be reasonably valued. We don't draw our conclusions in any of our models, and we'll take a conclusion at the very end. The sector comparison, it is slightly lower than the energy ratio at 7.1, and as mentioned earlier, it is heading towards that 52-week high, but that doesn't necessarily mean it is overvalued or undervalued if it was at the 52-week low. Now, what we want to do is take a look at the distributable cash flow ratio, the payout ratio to be accurate. Now, what we can see here is for LMPs, we like to see below 90%. There was that period of 2013 to 2017 where it was much higher, in fact, higher than the income they were bringing in. But what we can see from 2018 onwards, which has been a bit more consistent, it is below that 90%. And we can see 2022, 42%, 2023 is expected to be 50%, which does give, I guess, in terms of that dividend safety, you can understand why it is as it is currently. Now, what we want to take a look at is the DCF per share, and typically we like to see an upwards trend, 64 cents in 2013, $2.40 in 2022. So there has been that nice increase over the period, but understandably, we can see some years that were a decrease, 2016 to 2017, and a very strong increase from 17 to 18. So 2023 is expected to be higher at $2.46, so that is positive to see, but moving forward, you would want it to continually increase. Now, sales growth, typically you'd be looking for 3 to 7%. However, due to the cyclicality of the industry, you would see what we can see on the screen. 2013, 185%. And then we can see these 3 years here where there was negative double-digit percentages. In terms of the long term, we can see 2013, 48 billion worth of sales and 90 billion in 2022. So whilst there has been that increase over the last 10 years, we can see a clearer picture of the business and how it operates by the fluctuations year on year over the last 10 years. Shares outstanding, typically for most companies, we look for companies that do share buybacks and return excess cash to shareholders. The opposite is true where companies are issuing shares and diluting yourself as an owner. So 1.12 billion worth of shares outstanding in 2013, 3.1 in 2022, almost 3 times as much. Now, whilst this is typical for many LMPs, it isn't exactly what you want to see in terms of the growth and that very, very sharp growth. 1.12, almost 3 times as much in 2022. Return on invested capital, I personally like to see around 10%. So it means that management are effectively allocating that capital. What we can see is whilst it is around that 10%, it is over the last 10 years been below quite consistently. So I would like to see at least 9 to 10% again for 2023. Now, the operating margin, what is good to see is the fact that it has increased from the 5% in 2013 and 14, but we would like to see at least 12% consistently. Given that from 2020 to 2022, it has been between 9 to 15%. That isn't the worst case. And then finally, what we want to take a very quick look at is that net debt to earnings before interest, tax, depreciation, and amortization. I was slightly worried when we looked at the balance sheet versus the cash versus the total debt. But what we can see is our preference is below 4.5, and from 2018 onwards it has started to come down, with 2023 expected to be 3.55, which gives me more faith in that dividend won't be cut unless things radically change. Now, this is just the net debt to capital, showing that in 2022, 54% of the company's financing was from debt as opposed to equity. As always, if you are enjoying the content, do hit the like button, do subscribe for more content on your doorstep. And if you want to run your own company through the stock valuation model, do grab a copy in the link description. Now, we'll run through the stock valuation model for ET. We have the earnings per share, the growth rate as expected by analyst estimates with that yield on AAA corporate bond, showing an intrinsic value of $15.41, showing some nice upside to that current share price. We then move on to the multiples model with companies in a similar sector and size. We have Enterprise Products, Kinder Morgan, and Targa Resources. We get the P multiply by getting the stock price and earnings per share. We then do the average multiplied by the EPS to get a stock price of $20.40, again showing some nice upside to that current share price. Then we look at the yearly dividends year on year, which do tend to fluctuate quite significantly with the average around 5.7%. However, I've gone for a much lower and much more conservative rate at 2.5%, and this gives a nice DDM price of $22.92, again showing nice upside to that current share price. Finally, we get the discounted cash flow model where we have the free cash flows year on year with the average at negative 200%. Now, we do use the analyst estimates for this model for energy transfer at 2%, and using our discount rate, we get the present value of these future free cash flows and terminal value. Once we add that together with the cash, subtract the total debt, get to our equity value, we divide that by the shares outstanding to get to a DCF price of just under $18. As always, if value is being provided and you are enjoying the content, do hit that like button and do subscribe for more videos. So the intrinsic value is essentially the average of the 4 models we've just gone through at $19.18 based on our own estimates and judgments. Again, if you want to run through your companies through this model, do check the pinned comment and do go through your own judgments and your own estimates. So the current price, as we can see here, is around $12.90. Typically, for a company with a wide moat and strong financial metrics and forward-looking guidance, I would be looking for 10%. However, you could justify it much higher for energy transfer. 10% margin of safety would give you $17.26 as your buy price, meaning it's a buy now. 20% margin of safety, you'd be looking for a buy price around $15, again showing another buy. For me personally, I think you could justify a margin of safety of 30%, which is essentially showing that it is still an acceptable buy price with around 30% margin of safety if you were to buy now. Wall Street do, however, forecast the price over the next 12 months to show some very, very strong upside as well at $17.50. So there is significant upside in my opinion as well as Wall Street's. As always, let me know your thoughts in the comments. Are you a shareholder? Have you been buying years ago? Are you on the sidelines, or are you a shareholder looking to sell? And as always, like, subscribe, and catch you on the next episode, and have a great, great day.